Everyone talks about dollar stablecoins. Over the last 3 years, local currency stablecoins grew faster. Non-USD supply grew by about 3 times. Dollar stablecoins grew by about 2 times. That gap matters, because if you are building payment infrastructure, treasury tools, or digital assets products, you can end up optimizing for the market everyone knows, not the one that is actually gaining momentum. Stay with me, and by the end of this video, you will know which local stablecoin markets are really scaling, why they are scaling now, and what that means for your roadmap. The stablecoin story was easy to tell. USDC, USDT, dollar liquidity, end of story. But that story is now too simple. What changed? Not just sentiment, something more practical. In more markets, businesses now have a way to move local money on blockchain rails without forcing everything through the dollar first. That means less converting, less waiting, less money stuck in the middle of the process. And if you are a CTO, head of payments, VP engineering, or digital transformation leader at a bank or PSP, the pain is probably familiar. Cross-border payments take too long. Conversions eat margin. Treasury gets messy. Each market works a bit differently, and every extra step adds more operational effort. At SPO Software, we work with financial institutions and fintech teams that are trying to fix exactly that. Payments, ledgers, settlement flows, digital asset logic, compliance-heavy systems. And what stands out here is very practical. The growth is not just in more stablecoins. It is in stablecoins that keep value in the local currency and fit how that market already works. So let me break this down into 4 parts. First, what the numbers actually say. Second, why this shift is happening now. Third, what Europe, Brazil, Japan, and Singapore can teach us. And fourth, what banks and fintech teams should do with that insight. Local currency stablecoins are not growing because of hype or new stablecoin creation. They are growing because more people are using them in real everyday situations. The first thing to understand is this is not a cosmetic shift, and it is not one token having a good quarter. A useful reference here is the Beyond Dollarization report by Visa and Dune. Once you adjust for EURC by Tether, dropping out after MiCA-related changes, non-USD stablecoin supply grew from around $350 million to more than $1 billion in a bit over 3 years. Over the same period, dollar stablecoins also grew, but more slowly. That matters. But supply is only half the story. The stronger signal is adoption. More people started holding these assets. The number of holder addresses grew from around 40,000 to more than 1.2 million. This is a huge jump. Then you see the same thing in activity. Monthly senders went from roughly 6,000 to about 135,000. So this is not just money sitting still. More wallets are actually using it. And then comes the biggest signal of all. Monthly transfer volume rose from around $600 million to about $10 billion. That is when it stops looking niche, but starts to look like infrastructure. Think about it like this. Supply is how much road you build. Usage is how many vehicles are actually driving on it. That matters for banks and PSPs, because market size on its own can mislead you. A token can get bigger without becoming more useful. But when holdings, activity, and volume all rise together, that usually means the asset is starting to behave less like a niche instrument and more like a working settlement rail. A lot of teams still assume if a stablecoin market is smaller than the dollar market, it is strategically unimportant. That is the wrong lens. In infrastructure, the better questions are: where is usage growing, where are the rules getting clearer, and where are real production use cases showing up? When we look at this trend like this, we do not start with token popularity. We start with workflow fit, settlement, treasury, reconciliation, compliance, corridor economics. That is what tells you whether something is strategically relevant or just noisy. So the numbers are moving, but the bigger question is why now? What changed that local currency stablecoins are much more viable? Here is the simplest way to frame local currency stablecoins. They are digital versions of national currencies like the euro, Brazilian real, yen, or Singapore dollar, issued on blockchain rails. Their job is not to replace those currencies. Their job is to help move them faster and more flexibly. Why does that matter? Because many businesses do not want extra dollar exposure in the first place. If you earn in euros and pay out in euros, routing through dollars adds friction. If your payroll is in reals and your suppliers are in reals, converting through dollars adds cost. And if you move money across borders often, every extra conversion usually means more delay and less margin. That is where local stablecoins start to make sense. They help move money without changing the underlying currency. That sounds small, It is not, because in practice, it can mean fewer unnecessary conversions, simpler treasury flows, and faster settlement. Then there is second reason adoption is speeding up. The rates are getting better. Payment networks and fintech platforms are making these stablecoins easier to plug into cards, payouts, wallets, and settlement systems. That changes the adoption story completely. You are no longer talking about replacing the whole stack. You are improving one painful part of it. That is much easier conversation inside a bank. Visa is a good example of this shift. It supports stablecoins across settlement, payouts, cards, and fiat connectivity. There are more than 175 million acceptance points and 14,500 financial institutions in Visa's network. That tells you this is not just about token issuance. It is about integration into real payment distribution. The mistake is thinking the winning model is stablecoins versus traditional finance. In reality, the stronger model is much less dramatic and much more useful. It is stablecoins integrated into traditional finance. From an engineering point of view, this is where we would look first. Where can this plug into the current stack, remove one painful step, and improve speed of control without breaking everything else? Now that explains the why, but the market is not moving evenly. Some regions are clearly ahead. Let's talk geography. Europe is leading. By February 2026, Euro stablecoins made up more than 80% of the tracked local currency stablecoin market. Brazil came next at around 10%. Singapore dollar and Japanese yen stablecoins were much smaller, but still strategically important. So yes, Europe leads, and that's not random. Mika gave the market something institutions need: clear rules, clearer reserve logic, clearer redemption expectations. That did not make adoption automatic, but it made the market much easier to take seriously. Then look at Brazil. Brazil matters because it shows what happens when stablecoins connect to something people already use every day. In this case, that is PIX. Once local stablecoins connect to domestic payment rails like that, they stop feeling like crypto products and start looking like payment infrastructure. Japan is another strong signal, still smaller than Europe, but strategically important. In Japan, activity picked up after the rules become clearer. The changes in the Payment Services Act and the launch of regulated yen stablecoins like GPYC. Monthly sender activity rose to around 10,000, but it's still smaller than Europe. But the direction is important. It shows what can happen when a local currency stablecoin gets legal clarity and a proper path into the market. And then there is Singapore. Less explosive, more steady, which is actually useful, because Singapore shows what adoption looks like when the product fits into habits people already have. Users can still pay the way they already pay, with a wallet, a card, or a QR code. Merchants still receive Singapore dollars. That is why examples like Grab, Ant International, and Chocolate Finance matter. They show that local currency stablecoins do not need to feel like a crypto product to the end user. They can work quietly inside a payment experience people already understand. And that is a big signal for the whole market. The fastest growth does not always show up where the story is loudest. It often shows up where the product fits best. A lot of teams treat this like one global race. It is not. It is a set of local races, each with different rules, race, and user behavior. If we were mapping product strategy here, we would not treat stablecoins as one market. We would treat them as country-level infrastructure bets. Europe, Brazil, Japan, and Singapore are different compliance stories. And that brings us to the most practical part. What the strongest examples actually have in common. EURC by Circle shows what happens when a euro stablecoin stops being a niche asset and starts behaving like a real euro settlement layer. By early 2026, it had passed 400 million euro in supply and was processing very large monthly transfer volumes. That matters because it shows real demand for moving euro value direct without defaulting to dollar raise first. Then there is BRLA. This one interesting for a different reason. It shows how strong the model becomes when the user barely notices the stablecoin at all. In Brazil, BRLA connects to payment and treasury flows through tools people already know, especially PIX and card-based experiences. That is a great design lesson. When the stablecoin disappears into the workflow, adoption gets easier. And then XSGD. XSGD matters because it shows how local stablecoins can sit underneath regional payment flows. The customer keeps using familiar wallets, cards, or QR codes. The merchant still settles in local currency, but the system in the middle becomes faster and easier to operate. So what do these examples have in common? Not hype, not branding, not token design alone. What they share is a stronger system around them, clear rules, a connection to local rails, useful treasury logic, and an experience that feels normal to the end user. That is the pattern. The common mistake is treating the token as the product. Usually it is not. The real product is the system around it. And from a SPO software's point of view, that is exactly where we operate. In the ledger, in settlement, in payouts, in reconciliation, and in the experience layer that hides the complexity. But here is what most people miss. The biggest local stablecoin opportunity may not be in the weakest markets. It may be in the strongest ones. That sounds backwards, because the old narrative was simple. Stablecoins win where local money is unstable. But this is not the full picture anymore. What we are seeing now is something more institutional. In places like Europe and Japan, local stablecoins are starting to look less like emergency tools and more like normal financial infrastructure. Regulated, predictable, a bit boring, and honestly, that might be the real turning point. Because when something becomes boring enough for institutions, it becomes much easier to scale. So let's land this. Local currency stablecoins are still smaller than dollar stablecoins, but they are growing faster. More importantly, they are being used by more people and in more real workflows. That is the signal that matters. Europe leads today. Brazil shows how local rails unlock utility. Japan shows what clear rules can do. Singapore shows how this works when the user experience stays simple. And the strongest examples all share the same pattern. They are not just tokens, they are complete systems. A practical first step you can take today. Pick one cross-border or treasury flow in your business. Look at where money slows down. Look at where conversion costs build up. Look at where teams still do manual work. And then ask one simple question. Would this flow work better if the value stayed in the local currency from start to finish? That is where the real discussion starts. If this helped you think differently about local stablecoins, drop a comment with the market you think moves next. And if you disagree with the thesis, even better. And if your team is actively exploring stablecoin settlement, digital asset infrastructure, or multi-currency payment architecture, and you want a delivery partner who can turn strategy into production, you will find a link to talk to the SPO team below. Thanks for watching, and remember to stay on the block to stay ahead.